All right. Can everybody see my screen? Well, welcome to the YFP Fellowship. I believe this is meeting number 8. So we have 4 more meetings. Today we're going to talk about tax. So we started this back in June. We've been meeting every other week pretty consistently since then. We're going to do taxes today. We're going to do insurance next time we meet, which is on October 12th. Insurance would cover kind of life insurance, disability, professional liability. If you have questions about home and auto or any kind of property casualty, we'll talk about those as well. And then I don't have a following topic. So some of the things we can talk about, if you're interested, would be combining finances, where two or more people combine their finances into a family, kind of new addition planning, which could be creating or purchasing a child. I prefer that over adoption, terminology wise. College education planning. I don't think we have a lot of people who are planning for kids' college, but that's out there. Car purchase, estate planning, real estate investing, financial independence. I think maybe a conversation that would be useful for a lot of the class. Just kind of what the fuck does that mean? And like, what does the timeline math-wise look like? Or are there any other topics that people want to kind of throw in this list? Your vote counts more this week because there's less people here to argue. So if anybody has an opinion. This is the one time this whole year your vote's going to count. No? All right. So we'll talk again when we do insurance and we'll figure out what people want to go with. All right, so the agenda today is to talk about taxes, right? So we'll do an overview. We'll talk about some of the changes in the tax code. We'll talk a couple about strategies, some navigating, and then maybe some references and recommendations. So in this world, nothing can be said to be certain except death and taxes. Benjamin Franklin. So taxes are always going to be something that we're going to have to deal with. So we just want to make sure that we at least understand what's being subjected on us. So a little overview. So what's at stake here, right? So like, how much money are we really talking about? So the average pharmacist over their career is going to make over $9 million. So there's a lot of money that's out there, right? That sounds crazy, but just over time, that's what everything's going to add up to, right? So it's a lot, just all the monies. But only $6 million of that total will ever even kind of make it to you, because Uncle Sam's going to come in and take a huge bite of that sandwich. Okay. So he's over here taking basically a third over your lifespan, maybe more depending on where you're at. I just found out that Minnesota apparently is paying like 11% in taxes. So depending on where you live, it's going to matter more than California. So what does the general calculation look like for taxes? So I'm gonna say some things here. It may or may not make sense. So please either give me nods or give me a hand raise if something sounds off. But basically, we start with your income, right? So whatever your income looks like. So that could be your W-2 income. It could be 1099 income. It could be your proceeds from Facebook Marketplace selling bricks out of your driveway, which sounds odd, but we have a client that has made over $20,000 selling bricks from their driveway, cobblestone bricks. So don't knock it until you do it. So we take our income and then we get exclusions from that, right? So we get to deduct that a little bit, right? So some things do not have to get charged taxes, right? So life insurance proceeds, workers' comp, benefits by the employer, health insurance, stuff like that. So we just subtract all those. And that gives us our gross income. So W-2, 1099, alimony, there's some debt forgiveness, maybe mileage allowance, rent collected, severance pay, jury duty fees, super important. I don't know if anybody's ever even done jury duty, but gross income. And then we get deductions from that. We get to deduct out IRA contributions. We get to deduct out 401k, 403b contributions. We get to deduct out HSA contributions. Occasionally, we get to deduct student loan interest, right? Once we take all those out, we get what's called our AGI, or our adjusted gross income. So our gross income that was then adjusted, right? Adjusted gross income. From our adjusted gross income, we subtract out any of our deductions. So we could do either an itemized deduction or a standard deduction. We'll talk about those here in a little bit as well. From our itemized deductions or standard deduction, away from our AGI, we get down to what's called our taxable income. So this is the amount of income we actually pay taxes on. So how much money you make on your W-2 is not how much money you pay taxes on. We have to do all these things before we get to our taxable income. We take that taxable income and we compare it to the tax brackets, and we'll go over that in a little bit. And that gives us our tentative tax due. So we take our taxable income, compare it to tax brackets, and that tells us how much taxes are owed. And then we subtract out any allowances or credits. So we have a child independent care credit, child tax credit, American Opportunity, lifetime learning credit, all of that, plus any taxes we've paid throughout the year. So anything we paid throughout the year gets subtracted from there as well. And that leaves us with a tax liability or a tax refund. So when you go on TurboTax every year and they do all that math and it says, hey, you owe us money, that's a liability, or hey, here's some money back, you paid too much throughout the year, that's how you get your refund. Does that basically make sense? All right, now let's talk a little deeper. So tax strategies. So when it comes to paying taxes, you can avoid it, defer it, or pay it, right? So tax avoidance is not just refusing to pay your taxes. You're not Al Capone, but it is trying to find ways to not have to pay taxes, right? So you're not choosing not to pay taxes. You're finding legal ways to not have to pay taxes, right? So that could be maximizing your tax credits by lowering your AGI, making sure you get those credits for education or for kids. It could be earning tax-free income, right? So finding ways to earn tax-free. Sometimes that means working overseas, right? You get an exclusion of like $92,000 for working overseas. Maybe it's getting interest from government bonds. Maybe it's contributing to 529 college savings plans. Those can avoid taxes depending on what state you're in. Maybe it's making HSA contributions. Those are triple tax advantage, as we talked about before. Maybe it's grouping itemized deductions. For most of you, you're going to use the standard deduction, but which we'll talk about, but itemizing as well can work. Paying childcare bills through a dependent FSA, flex spending accounts. Home sale exclusions allow us to avoid taxes, which is where if you sell your house and it was your primary residence, you get to exclude $250,000 of income from the sale, capital gains from the sale. But that's how we can avoid taxes. There's also ways we can defer taxes, meaning pushing it to future years, right? So again, lowering your adjusted gross income. It's important. We can use phase out credits and deductions, using taxable buckets like IRAs, 401ks, 403bs allow us to defer those taxes until a later date. Most of you will not have access to a deductible IRA after residency because you're going to make too much money. So you're going to have non-deductible IRAs, or you're going to have Roth IRAs maybe. So mostly we're talking about 401ks here. So we can defer taxes by putting money in 401ks. Student loan interest deductibility or IRA contributions if we have them. Or we could choose to pay our taxes. Maybe we want to pay our taxes now, right? So that's contributing to Roth IRAs, Roth 401ks, Roth 403bs. The difference between a traditional and a Roth we talked about. A Roth, you pay taxes today, then the money goes into an account and it can grow tax deferred. And as long as you use it appropriately, it comes out tax free. That makes sense? All right. Other ways, backdoor Roths. So if you don't have access to a Roth IRA, you don't have access to a deductible IRA, you can do what's called a backdoor Roth, which is where you make contributions to a traditional IRA that are not deductible. You can do that whenever you want. Non-deductible traditional IRA contributions. And then at the end of the year, you can convert those contributions to a Roth IRA. So you go through the back door. It's kind of like a gray area in the tax law, but it's been approved by the government. So it was probably an oversight that they've just let slide now. It's not the greatest thing since sliced bread, as some websites will make it out to be, but it is an option that is available to you. So ideally, what's the best strategy, right? The best strategy here is to pay the least amount of taxes without going to jail. I don't want to give the government any more money than I have to. I like my money. I'd rather spend it on me. I like to eat a lot of nice foods. And if I had less in tax money, I could spend it on more nice foods or travel or any other thing that I want to pay for rather than like an aircraft carrier. I don't know, whatever the government spends money on. So it really comes down to what's most important to you on how we want to do this. Do we want to pay taxes today? Can we afford to? Do we want to pay taxes later? Do we want to go these special routes and take advantage of these tax credits and tax loopholes? It's going to come down to your preferences. It's also going to come down to what your expectations are. What's your tax rate today, and what do you expect your tax rate to be in the future? If you believe that your tax rate is lower today than it will be in the future, then it would make sense to pay more taxes today. If you think your tax rate is higher today than it will be in the future, it makes sense to defer taxes into the future, right? But we don't know what taxes are going to be down the road. And that is not the only variable in this calculation of how else does this impact you, right? So for some of you, student loans are a big issue. So we want to make sure that we're paying the least amount if we're going for forgiveness. So controlling our adjusted gross income is going to control what our student loan payment is. So although we may be in a low tax bracket today, and theoretically a Roth contribution could make the most sense, if we're also factoring in student loan payments, then maybe we want to go traditional to lower that, which would lower student loans, which would lower forgiveness, which would lower la, 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 la. Does that make sense? What I'm saying is things are integrated, right? So all these decisions are going to flow in and amongst each other. And it's really going to come down to what your specific preferences and your specific situation entails. Any questions so far? No. All right. So changes to the tax code. So the tax code changes from time to time, right? So it's not just something that we can learn one time and move on with our lives. Every new government that comes in, whether that's the House, the Senate, the executive branch, whatever, they always try to improve the tax code for their constituents. So we had a couple times that this has changed recently. So under President Trump, there have been two major tax changes, which is uncommon for one presidency. But we had the Tax Cut and Jobs Act that happened back in 2017. So this was kind of a big platform for his campaign. He was going to cut taxes. He was going to simplify the tax code. They used to make a big show. They had all these like stacks of paper, and they're like, we're going to cut all these out of the regulation. They didn't really do that, but they did do some things. So they didn't change how many tax brackets there are, but they did change what the rate was for them. So we still have 7 tax brackets in the US, but now they're a little bit lower than they were before, right? Does everybody understand how tax brackets work? Does anybody not understand how tax brackets work? Does anyone want to pretend they don't know so I can explain it anyway? Cool, thanks. So how do tax brackets work? So let's say, for instance, we're about to graduate, we're going to make $100,000, right? We're an individual and we're going to make $100,000. So if I look on this tax bracket, I can say, okay, cool, I'm in the 24% tax bracket. But that's not necessarily what it means. When taxes come into play, it's a pooled system. So you first calculate the first $9,700, and that's taxed at 10%. The next, basically, $30,000 is taxed at 12%. The next, basically, $40,000 is taxed at 22%, and then the next $80,000 is taxed at 24%. So your marginal tax bracket will be 24, meaning your next dollar will be taxed at 24%. But your average or effective tax bracket may be closer to like 18%. Does that make sense? Right. Okay, cool. So let's say, for instance, you're making $84,000 and you're in this 22% tax bracket. And you're like, okay, cool. And your boss comes to you and says, hey, we're going to give you a raise. You're going to make $85,000 now. And you're like, okay, cool, free money. But then you think, oh, I'm going to get bumped into the next tax bracket. I have actually had clients and my mother believe that they're actually going to lose money in that transaction, that they're going to get a raise from 84 to 85, but now everything's going to get 2% higher taxes, so they're going to lose money. So that is not the case. It just means that next $800 would be taxed at this tax bracket. Does that make sense? All right, cool. So now everybody understands that. We never have to worry about it again. Okay. So what else did the Tax Cut and Jobs Act do? So it also doubled the standard deduction. So earlier we talked about the itemized deduction or the standard deduction. We'll talk about that a little bit further still, but basically it's how much do I get to take out of my taxes for expenses. And the standard deduction, it used to be 70% of all Americans would take that standard deduction, and now it's 85%. So it's gone from 70 to 85%. So they did simplify the tax filing process for many Americans without actually simplifying the taxes themselves. They limited a bunch of things like the cap on SALT, or state and local taxes. So it used to be the state and local taxes, you could just deduct as much as you wanted. Now it has a cap of $10,000. They eliminated a couple things. They extended the 529 savings accounts. So 529 are a college savings fund. And it used to go just towards, post-secondary schools. So just kind of like undergrad and graduate degrees. But they changed it. So now it's able to pay for primary and secondary education. So it's able to pay for private schools for kids and other trade schools. So that was a benefit. And then it changed a little bit about how student loan forgiveness works. So they got rid of a little bit of the deductions that you could take for student loans. One of the big things that they talked about was Paul Ryan used to carry around like a note card in his pocket, and he would say, someday you're going to pay your taxes on this note card. And he was really excited. That obviously never happened, but they tried. And I'll explain later kind of how they almost did that. The second big act that got passed was the Secure Act, the Setting Every Community Up for Retirement Enhancement Act. Somebody got a raise because they came up with that word. So this happened at the very end of 2019 and actually went into effect earlier this year in January. So this was the second major piece in 24 months, which is kind of unheard of. It was passed December 20th of 2019. It went into effect January 1st of 2020. So a super quick turnaround. The big thing here is it got rid of stretch IRAs. So a stretch IRA, also a beneficiary IRA, was basically, let's say someone you knew but not your spouse passed away, and they left their IRA to you. You could stretch the tax implications of that over the remainder of your life. And now you can no longer do that. Now you have to take the tax implication within the next 10 years. So it used to be you could stretch it your whole life. Now you have to take it within 10 years. They also changed some of the IRA contributions where you used to not be able to make any contributions past 70 and a half. And now you can keep making contributions as long as you're working. The required minimum distribution, basically the Uncle Sam wants his bite of that sandwich from your IRA. He never gets it because you make deductible contributions that are deferred until you take it out. Used to be you had to take it out starting at 70 and a half. Now you don't have to take it out till 72. A couple other things. Any big questions about how the tax code has changed, knowing that it will change again in the future? Nope. All right, riveting stuff, guys. All right, deductions and credits. So who knows the difference between deductions and credits? All right, perfect. So deductions and credits. The big thing here is deductions lower your adjusted gross income. Credits deduct your tax bill. Okay. So if I had a $1,000 deduction and a $1,000 credit, the credit is exponentially more valuable. All right. So here's an example. I make $100,000 and I have a $1,000 deduction. Now I make $99,000 and I'm still going to pay taxes on all that. If I have a $1,000 credit, if I have a $10,000 credit bill, now I have a $9,000 credit bill. So I actually saved $1,000. Does that make sense? I got a maybe on that face from Steven.
Got it.
Okay, cool. So deductions just lower your income, right? So some of those deductions are either the itemized deductions or the standard deductions, right? We talked about. So itemized deductions would be you adding up all these different types of deductions and making them more valuable than the standard. So some of these would be like, hey, medical and dental expenses. It could be charitable donations. It could be state and local tax. It could be home interest. It could be gifts. It could be any number of things, work expenses, right? And those get to deduct from your income. If your itemized deductions add up to more than the standard deduction, you take them. If they add up to less than the standard deduction, you just take the standard deduction. That's just how that works. Credits, on the other hand, credits are incentives. So credits are what the government uses to incentivize you to do certain things. and they say, hey, we want you to be an educated population, but like not too educated, but like an educated population. So if you do lifelong learning, basically, if you go to school, we allow you to save some money from that. So for most Americans, it provides a federal income tax credit based on the first $10,000 of post-secondary education. That credit can be given in $2,000 increments. So that's huge. The American Opportunity Credits is for eligible students for their first 4 years of higher education. So sending your kids to college can actually save you money. The child and dependent care allows you to deduct some of your expenses for childcare because the U.S. government wants you to have a family. The child tax credit just kind of gives you $1,000 for having a kid. So congratulations, kids are expensive. Here's $1,000. That totally pays for them. Stephen, as you know, kids only cost $1,000. So there's that. And that's how credits work. So when the government wants to incentivize you to do certain things, they will offer a new credit to do that. So you want to make sure that you're taking advantage of all these credits when you do your taxes, which is sometimes why it's better to work with a tax professional, because they'll be able to find the credits that you either almost qualify for and help you go over the edge, or the things that you already qualify for, but we're not aware of. Does that make sense? All right. So the standard deduction. So we talked about, hey, if I take the itemized deductions, I have to add them up to a certain point, and then if it's less than the standard, I take the standard. So what is the standard deduction? So it got doubled in the Tax Cut and Jobs Act. So it used to be for a single person was $12,200. Now, it used to be $6,000, and now it got increased to $12,200, and the new year it got bumped up to $12,400. So it used to be $6,000, now it's $12,000. For a married couple, it used to be $12,000, now it's $24,000. For married filing separately, it's just like being single. And for head of household, it's basically 150% of being single. So these are the different filing statuses. So you have to know where you qualify in these, right? So single would mean you file alone. It's just you. Married filing jointly would be you're legally married and you file your taxes together. Married filing separately would be you're legally married and you choose to file your taxes separately. Head of household would be you have dependents under you, but not a spouse. So this would be like I'm a single parent taking care of kids. This could be I'm an adult taking care of my dependent parent or sibling. Basically, I am a single person, but I have dependents that I care for. Does that make sense? There are other ones out there like widow, qualified widow, widower, some other things out there. They're less common. So if you have some of those conditions that pop up, please talk with a tax professional because I am not one. Although I did stay at a Holiday Inn Express last night. Is that still a commercial? No, I don't think so either. Yeah. All right. So navigating your tax returns. So there are a ton of different forms with taxes. Taxes are supposed to be simple, but they're not at all. So these are some of the different forms. So we're going to talk very briefly about some of these, just so I want you to hear these terms so you've heard them next time you see them. So W-2, wage and tax statement. This is where your income is stated. For most people, this is the most important tax form you're going to have. You get it at the end of the year. It says how much I made, who I made it from, how much taxes were taken out for everything, and where they went. All that money, all that data should be tracked on there, so that way you don't have to track it yourself. A W-4 is the employee's withholding allowance certificate. What this does, this is basically where it says, how much do I want to withhold from my taxes? The old form, which used to look like this, would basically say how many credits or how many allowances do I want to take out? And you'd hear people say like, oh, you have to take 0 or 1 or 2 allowances, right? The new W-4 form does not work this way. They basically calculate your taxes for you at the IRS, and then they just take out the appropriate amount, all right? So that's a W-4. Whenever you start a new employer, this is the form that they require you to fill out so they know how much of your taxes you would like withheld. If you get this math correct, you won't owe any taxes at the end of the year, and you won't get a refund at the end of the year because you got it correct. Nobody ever gets it correct. You're either high or low, and you find out which way you want to be on that. Do you want to pay too much and get a refund, or do you want to pay too little and get a bill? There are people that will argue both sides of that debate. I don't want to give the government a tax-free loan. I don't want to have to worry about paying a bill in April. Everybody has a preference. I choose to always get a refund. I accept I'm giving the government a free loan, but I never want to have a surprise bill come spring. Because spring is when I lose money in March Madness. That's when I need that money to lose. 1040, individual tax return form. So this is the normal form that people will fill out when they fill out their taxes. So this has all the data from all these other forms tied to it, and it's just the Cliff Notes, right? It's 2 pages long. It's the Cliff Notes of what your taxes look like. 1040-SS is the same form for those who are self-employed. 1040-X is if you're amending a previous return, meaning I'm making changes to a previous year. 1099. Is anybody a 1099 employee? No? Somebody on the phone maybe? A 1099 employee or 1099 form is for miscellaneous income. So there are a ton of different types of 1099s. So you can get a 1099 from your employer, meaning you're like a contract worker. You could get a 1099 from a bank account, and that could be a 1099 INT, which stands for interest. If you have investments, you may receive a 1099 DIV, which stands for dividends. If you have retirement accounts and you withdraw from them, or sometimes not, you may still get it. You can get a 1099-R, which is for retirement. You can receive a 1099-C for canceled debt. And there are other 1099 forms, but basically it's all miscellaneous income. So just different income, right? And those get tracked accordingly. And then you have the schedules. And the schedules are the forms that give you the data to fill out your 1040. So A is itemized deductions, if you do itemized deductions. B is for interest and ordinary dividends. C is for profit and loss from a business. D is for capital gains and losses. E is for supplemental income and loss. SE is for self-employment tax. All these forms, if you need them, are the only time you fill them out. If you need them, then that data goes on to the 1040. Does that make sense so far? All right. If you ever need an extension, you file a form 4866, which allows you to get a 6-month extension, which is why most times taxes are due in April. This year they were due in July. If you need an extension, they would do in October or December, depending on when you filed. All right, back to Paul Ryan. Paul Ryan was the Speaker of the House. He used to work out. He kind of ran for president. He didn't do great. He was running around saying, hey, you're going to pay your taxes on this like card here. And that wasn't a thing. Kinda. So they made that happen. That postcard exists, except it's double-sided, and you have to fill out these other 6 forms. So like, they kind of did it, but you have to fill out all these other forms to do it. These 6 forms are eerily similar to these forms. Who knew that we would still need those? But let's just take a look at these. So I've kind of explained what they are already, but again, W-4, this is where you choose your withholding. There's actually a great calculator online now. So if you need to fill out this form in the future, you can just go straight to the IRS with your pay stubs and fill in some information, and it'll pre-print you one that has all the correct data on it. It's really, really better now. 1040, again, this is that tax return form. So this, you're gonna fill out, hey, this is my filing status, this is me, my family, this is where we live, these are all my dependents, I put all their information on here. These are my wages for my W-2. This is the information from different forms and different sheets. I add that all up on there. Tells me how much tax I have due, tells me how much tax I've already paid, how much I'm gonna owe if I owe any money, or how much I'm gonna get back. 1040 form, pretty straightforward. You can fill these out on your own. You can have someone fill them out for you. You can fill them out through a filing service like TurboTax. Any ways about that. Any questions on 1040? No, okay. Schedule 1, so these are those new 6 schedules, right? We're just barely gonna talk about this. So additional income, so this is basically we're gonna put all those other incomes that we have, all those adjustments we're gonna have for our incomes. And these are just the forms that give us the data to fill out the other forms, right? So it's just showing your work effectively. Yes.
Hey, sorry. Just for like, maybe I'm jumping the gun, but maybe this was already asked in previous lessons that I totally missed, right? But like as we're going through this, maybe you'll touch on this at the end. Do you recommend like doing it yourself versus like a TurboTax versus like hiring someone to do it? Because I've done both. I've done all 3. I did a consultant, I've done TurboTax, I've done it myself. And usually like I'm just lazy, right? And this is like, even as you're explaining to me, it's like, oh my gosh, there's so much information. So I usually like would prefer like, hey, I just take whatever out of my tax refund because I'm like you. I go low, so I get a huge refund back, right? Just take whatever out and just do it for me. But I was curious to know like, because you're teaching us, right, and we're learning, and we're going to be able to do this ourselves as we like learn from you. But do you recommend that, or do you think it's worth? Because we're all pharmacists, right? Time is money. Like, do you think it's worth our time to like go through this, or do you find that a lot of your clients are just like, you know what? As soon as I have some kind of investment or some kind of a complicated finance sheet, I just outsource it. I was just curious as we before
I
we get too deep.
Yeah, I have personally never done my own taxes. So although I am educated and knowledgeable enough to fill out these forms myself, I don't know what I don't know. And that's the reason I use a professional. Now, I also don't use a CPA or an EA right now. My taxes have historically been pretty simple. So I've just used TurboTax. I've used TurboTax my entire life. And I like that because it also stores all the data in one place. So I can see all my historical stuff in one place. Um, at this point, I'm probably paying for that simplicity, meaning that it's probably more expensive than it needs to be. As my life gets more complex, right? Homeowners eventually will have kids, will have business ownership possibilities. Then it'll start to make sense to bring in a true tax professional, like an enrolled agent or a CPA, to actually make sense of some of that stuff. But for right now, TurboTax does a phenomenal job. Not sponsored, by the way. I wish I could be. That'd be great. But I like a program that knows what to look for. Because although I could fill out a 1040, I wouldn't know what credits I'd be missing out on otherwise. I'm not staying up to date. I'm not a tax professional, so I'm not staying up to date on some bill that just got passed that allows me to save $1,500 because I got a golden doodle or some stupid shit that happens in Congress. So yeah, generally, yeah, I'd recommend using a service to do that for just that reason.
And at what point would you say, like, just to clarify, like, you would say, because I'm like you, I'm TurboTax all the way, but like, at what point would you say like, oh, now I feel like I should switch from TurboTax to like an actual like human being to like, at what point, like, do you have specific things like criteria or like assets at that point that you would make it so that it's more feasible for you to just have someone else do it, like person do it?
Yeah, so that question is actually getting harder and harder to answer because TurboTax is now employing CPAs and enrolled agents to like live answer questions for you. But historically, that answer has been basically whenever the software makes you uncomfortable. So whenever you're to a point where you're not comfortable with what you're getting from the software, then you go to a professional. It's just the price differential there is so high that TurboTax, if you have simple taxes, could be free for like state or for federal, then you pay for state. As a tax professional, they charge you a couple $100 or up to $1,000 depending on the professional. So basically, whenever I get uncomfortable is when I'm going to switch. I know that TurboTax has those CPAs and enrolled agents that they can answer questions for me. But when I have what I feel are complex taxes, I'm going to want a person that I can go to and say, Paul, please tell me what the fuck is going on here. Paul is our tax guy. We have a tax professional on staff. So for our clients, we actually do file their taxes. And I don't know most of the things that Paul knows. So I want somebody to go to and say, explain this to me, rather than me getting a generic call center person somewhere else, or me having to like look up tax regulations to file it on my own. So that's when I would make that switch. There's not a watermark to say, yes, you're now complex enough. It's really going to be personal preference because you may feel, I had rental properties and I still did TurboTax. So I still felt comfortable with rental properties. Other people would say, once you have rental properties, boom, go get a professional. I felt comfortable with that. If I had other business ownership, or if there were other big changes to the tax code, I would probably reach out to a pro. But for now, I'm pretty happy with TurboTax. It's all going to come down to personal preference. I'm not going to say it depends, but it depends.
I kind of have a follow-up question that's like a little bit like kind of a step forward. So now we're looking at, as pharmacists, as new pharmacists, we're kind of thinking about who are all the people we need to employ to keep our lives running smoothly. So right now we're looking at like financial advisement, which is, you guys, and then like a tax professional, a CPA, whoever have you. Are there any other people that you'd recommend for us right now that we should be thinking about employing?
Yeah, that's a tough one. Actually, I'm gonna give me like a second and a half here, because we actually have in the software that we use for financial planning, you guys got all on Right Capital. We switched after we started this to eMoney, and in there, it actually asks like, "Hey, what other professionals have you used?" And it says kind of like a brief little kind of thing about it. I want to see what list they have. Oh, cancel that. I don't know that I would recommend all these organizations they're going to say, but just kind of who's out there. It's really going to come down to like, what specific needs do you have in your life? If I am a real estate investor and I have a whole bunch going on, then I'm going to want some special title company that I work with. If I have a bunch of properties, I may want an insurance agent. If I have business problems, okay. So like accountant, CPA, attorney, an auditor if you run a business and you want somebody to audit you, financial advisor, insurance agent, investment specialist, a private banker, and other. So that's what's on this list, just so you know. So who would I recommend having kind of on your team? That's what you're asking? Okay. Anything that's outside your personal interests and experience, okay? So if you're going to buy a house, you're going to want a real estate agent, right? That's specific to that specific thing. But if you're going to do this more than once, then you want to have a good one on staff. If you feel like your taxes need additional stuff, then yeah, we want to have an accountant, an EA, an enrolled agent just means somebody who's able to file your taxes for you and represent you in court if you ever get audited. A CPA can also do that. An attorney, if you're doing a lot of legal stuff, but for most of the time, you're not going to need an attorney. The only time I would recommend an attorney for the majority of you is if you're creating estate documents like wills and trusts. If you ever have to write your own employment agreement, which is somewhat more common than I would imagine actually in this industry. So if you're going to work for a community pharmacy, they may request you to create your own contract. In which case you definitely want a contract attorney for that. If you do run your own business, I would say an auditor or a bookkeeper at the very least. An auditor would make sure that no one's stealing from you and you're not making huge mistakes. A bookkeeper would just make sure that you're paying people correctly. I think having a financial planner on staff or a part of your team is really valuable. They can help you, what I recommend for our clients, obviously, is we can help you learn from other people's mistakes so you don't have to make them on your own. On the journey of life, we can help you avoid the potholes that we already know are coming. So definitely something there. An insurance agent, probably not. A lot of these things can get outsourced now, right? So it's different than it was, say, 20 years ago when you needed that insurance person to go talk to. I'm going to say insurance guy because it was most likely a dude back then. That you had to have that insurance guy. When now, I mean, we recommend a lot of our clients go to Policy Genius. So like when we talk insurance in 2 weeks, you're going to hear me recommend Policy Genius. It's not because we get kickbacks, because like we don't, but it's because it's a marketplace. It's a good product. If I needed you to buy flights, I wouldn't send you to United Airlines. I'd send you to Expedia or Orbitz or Google Flights to find that stuff. So that's kind of what they have now. There's marketplaces for all these things. So you don't really need an insurance agent anymore. An investment specialist. I would argue that the majority of you are not going to need an investment specialist because your investments don't need to be that special. There's no need to be hyper complex in what can be a simple act of purchasing low cost index funds and ETFs. If you have the right financial planner on staff, they'll help you through that process. But again, the idea is to keep it simple, stupid. Like don't try to sexy things up that don't need to be there. A private banker is on this list. I don't know why you would need a private banker unless you're a real estate mogul who's trying to flip houses, or you need really special loans for a business. So Brittany, long way around this. Who do you need on your team? Once your taxes are complex enough, you need an enrolled agent or a CPA to file your taxes for the long term. You want somebody who's going to be familiar with your situation over time, so that way they can help you throughout the process. Not a 1-year H&R Block person that's just going to do this and forget about you. This is somebody that can be in your life and help you do things the correct way. Having somebody on your team like that is valuable, invaluable because you can talk to them and say, hey, we're thinking about doing this. Okay, cool. You should also do this and that. I talk about purchasing kids because I'm going to adopt a kid at some point. So like make one, buy one's our plan, just for your knowledge. So when you go about that, there's tax credits for that, right? There's tax credits for adopting a child. And if you do it in the right way or from the right places, you can get a bigger benefit from there. So having a tax professional on staff can help you through that process or let you know that it's available, which may make you feel like this is an option that you did not have access to before. It's like a $13,000 tax credit. So when we're talking about a $20,000 to $50,000 adoption process, that $13,000 could go a long way, which could make it feasible for somebody when it would not have been feasible otherwise. So having those professionals are huge. And then a financial advisor, at the very least, a lot of people would like to pretend that we're like the financial quarterback. Like, hey, I can't do everything, but I can get the ball to the right kind of person. I think that that's arguable, but I think it's a good point to having somebody on your team who knows where to send you for the right answer at the very least. Like, hey, I can't help you with insurance, but I know what insurance you should have, and I know where you should go to get good advice. Hey, I can't help you with your estate planning process, but I can help you go to somewhere you can get it. Having that person. Really, it's just anybody who's offering objective advice for an appropriate fee is good. Does that help at all? That was probably like 4,700 2 words for a simple answer. Yeah. All right. Okay, so Schedule A, back to the fun stuff. So Schedule A, so this is the general forms we're filling out. So itemized deduction, if we're ever gonna itemize our deductions, these are the certain things, these are what we have to track, right? So medical and dental expenses, you're able to deduct those from your income, but only after a certain threshold. And that floor, right now at least, is 7.5% of your AGI, okay? So let's say you make $100,000 adjusted gross income, and you spend $8,000 on medical expenses. You only get to deduct $500 of that. So $70,500, that's just you, and then $500 you get to deduct, right? So when, for a single individual, that standard deduction is like $12,400, you start to see how that becomes more and more the way to go for most Americans. If you have state and local taxes, that one gets capped at around $10,000. Interest paid can go out of there. Casualty and theft, like if your car gets broken into, you can take a little bit of a tax deduction there. But again, you got to go over the standard threshold. So for most Americans, we're not going to do this form. Schedule B, this is for if you get any interest from banks. You'll get Ally Bank will mail you something that you're supposed to put on here. Most people forget to put it on their taxes because it's so menial. But this is where we go. If you get dividends from any investments, you'll get a form from them. They will mail you 1099 INTs or 1099 DIVs. Schedule C's, profit and loss from a business. So if we have any businesses, this is where we put all the stuff on there. Schedule D, capital gains and losses. So if we have capital gains, are you familiar with capital gains? Good, you should be because you're going to have to deal with it. So with capital gains, there's two types. There's a short-term capital gains and there's a long-term capital gains. The difference there being, did I own this asset for less than a year or did I own this asset for more than a year? If you own the asset for less than a year, you pay short-term capital gains, which is just taxed at your income tax. So let's say you bought Apple stock at $100 and you sell it at $1,000. Cool, you have a $900 capital gains. You owned it for less than a year, so it's short term, which just means your income is going to increase by $900. That's all it means. Long-term capital gains is a little different. So long-term capital gains, you owned it for more than a year. So you bought it at 100, you sold it a year and a half later for 1,000. You have a $900 long-term capital gain. That is taxed at one of 3 brackets, and they're pretty simple. If you make less than $40,000, the tax bracket is 0. If you make more than $440,000, it's 20%. And if you make between 40 and 440, which is all of you, then your, after residency at least, then your long-term capital gains tax is going to be 15%. So for the majority of Americans, long-term capital gains is 15%. So if we look up here, earlier that marginal tax bracket was like 24% over 100,000. Down here it would be 15. So it would behoove you to hold investments for at least a year to avoid the short-term capital gains tax. Schedule E, if you're ever going to have a rental property or Airbnbs, this is a great place to put it. This is where you'll put it on your taxes. You get to deduct all the expenses that go in there. All right. Tax prep versus tax planning. So you have this tax person. They're going to help you with your taxes. Well, how are they helping you? Are they helping you prep or are they helping you plan? Okay. So planning is, so tax prep is the process of filing taxes, right? So that process is generally going to take effect between January and April. So starting in January, you're going to start receiving forms. You're going to get all your forms. You're going to either upload them into your computer program, or you're going to put them in your file folder, or you're going to hand them to your tax professional, and they're going to help you do that. They're going to take all the stuff from historical data, and they're going to calculate, tabulate, and manipulate that information to come up with how much tax you owe. Tax planning is forward-looking, okay? So tax planning is more of a long-term strategy. It's saying, what changes do we want to make now to help us in a tax situation in the future? So it could be, hey, let's make traditional contributions now. Hey, let's make Roth contributions now. Hey, let's put money in this HSA for this expense we're going to have in the future. Hey, let's start doing dependent care FSA accounts because we know we're going to have more childcare expenses next year because we're going to go back to work full time because there's going to be like 1 million new COVID babies this year. So it kind of permeates through everything, right? So a lot of times we're talking about taxes and I'm saying how intertwined these things are. So when we're doing tax planning, we're going to see how it impacts all the other aspects of the financial planning process as well. And it can be extremely helpful for complicated filings. So if you start having those complicated tax plans where we're working with an enrolled agent or a CPA to help us through this process, that planning is really going to be the value. It's not going to be them filing your last year's taxes. It's helping you make changes to prevent you paying taxes in the future, right? Additional resources. So here's some data for y'all. So these are some forms. You'll get these at the end when we share the slide deck. This is basically all those important numbers from 2019 and how they compare to 2020. So we're going to skip over 2019. I just kind of want to walk through these numbers real quick. So these are those tax rates that we have for individuals. So MFJ stands for married filing jointly. Single is for single, obviously. So the pools for how much you're going to earn. Estates and trusts, if you own one of those, you don't want to make a bunch of income in them because shit is expensive. AMT is alternative minimum tax. So this will be an issue for some of you, but not enough that I'm going to dig into it today. Long-term capital gains rates. So again, 0 is less than 40. 15 is from 40 to 440. 20 is more than 440. Standard deduction for married filing jointly or single. There's an increase over age 65. Social Security stuff you don't care about right now. Full retirement age for individuals. For right now it's 60, but this is definitely going to go up before it gets to us. Medicare. How much you can put in retirement accounts. So contribution limits change pretty regularly. So right now to a 401k, 403b, or 457, that maximum is $19,500. If we're over age 50, we can add an additional $6,500 to $26,000 total. 403b catch up there, $3,000. IRA contributions, $6,000 with the $1,000 catch up. Do we qualify for them? So basically, if I have access to a 401k and I make more than this, I don't qualify. If I make more than this, I don't qualify for a Roth. So most of you are going to out earn your access to these programs pretty soon. RMDs, health savings accounts. So if you have access to an HSA through your employer, this is the maximum you can put in there. So $3,550 for an individual and $7,100 for a family. Does that all make sense? All right, mostly. Questions. That was a lot of information, a lot of data, some good questions, by the way, and way too many words from me. I'm called many things, concise is not one of them, but anybody got any questions other than Brittany? I'll take related or unrelated questions. Nope. All right, well, look at us finishing on time. That's nuts. Next time, we're going to talk about insurance. Okay. So we're going to talk mostly about life insurance, disability, and professional liability. But if you have other insurance questions, I will be happy to try to answer them. If you want to submit anything, you'll see that. In the Mighty Networks page after this, I will post the video. I will post the slide deck. I will send out a reminder for the 2 weeks from now meeting, which I believe is on the 12th of October. And if there's nothing else, everybody have a wonderful evening. Enjoy the rest of your night and get out of here on time. Thanks for coming.